If you're trying to raise capital in the US as a foreign startup, there's a legal restructuring process you're going to run into before any investor will write you a check, and it's called a Delaware flip. And how prepared you are when that comes up will determine whether the raise keeps moving normally or you get delayed by months. Now, as someone who runs a law firm that helps startups raise and exit, and also being a two-time founder myself, I've helped a ton of foreign founders work through this exact process. And in this video, I'm going to walk you through exactly what the Delaware flip requires, how to know if you even need one in the first place, what the process looks like document by document, and what you need to have sorted before you initiate it so you can move through this without any unpleasant surprises. Let's get right into it. Why US investors require a Delaware flip? So a Delaware flip is a legal restructuring that reorganizes how your company is set up. Before the flip, your foreign company is the parent and it controls the IP, the operations, and everything else. After the flip, the Delaware corporation sits on top as the parent and your foreign entity continues operating underneath it as a subsidiary. That reversal is the whole point. Investors need to put their money into the entity at the top of the structure, and they need that entity to be a Delaware C Corp. The reason US investors require this is it comes down to control and legal familiarity. When an investor writes a check, they want equity in the company that controls everything else. If your foreign company is the parent, the investor is putting money into a structure governed by foreign law that they're not familiar with, and that introduces legal unpredictability, which is just too much of a risk for investors. By making the Delaware corporation the parent, the investment is governed by US corporate law, which every institutional investor in this country already understands Delaware specifically because it's the default for venture-backed companies because of how developed its corporate law is. Delaware has predictable courts, shareholder protections that investors know how to work with, and a legal framework that's been tested across thousands of deals. That predictability is a big part of why investors require Delaware specifically rather than any other US state. By the way, if you're a foreign founder yourself that's preparing to raise from US investors and you want someone to handle the Delaware flip and the legal side of your fundraising, click the first link in the description and book a free consultation with me. Now back to the video. Do you need a Delaware flip? The thing is, not every foreign founder needs to do a flip. If you've already started a company in your home country and have been doing business under that foreign entity, then you need a flip. This is because your foreign company already has assets, IP, employees, and operating history attached to it. And all of that needs to be under a Delaware parent company before any US investor will move forward. But if you haven't started a foreign entity yet, you can skip the flip entirely in that case, and you can just incorporate a Delaware C Corp from the start and run everything through it. There's no restructuring required because there's no foreign parent to reorganize. You can still hire employees in your home country, operate internationally, and raise from US investors without going through the full flip process. So the question to ask yourself is whether you've already started a company in your home country and done business. If the answer is yes, that means you need the flip before any US investor will write you a check. If the answer is no, that means just start in Delaware, keep the structure clean from day one, and the raise will go a lot more smoothly. We had one founder who was building a startup that was taking off like a rocket ship. They needed capital from an investor to pour gasoline on the momentum they were getting. They got into deadlock with their investor because the investor was US based and they were a UK based company. The investor wasn't willing to invest into the UK based company for many reasons, as I've listed above. Eventually, the founder had to do the flip to accept the investment. What happens in a Delaware flip? Now, the flip involves a set of documents that fall into 4 categories. The first category is the approval and share exchange on the foreign company side. The second is the documents that set up the Delaware entity itself. The third is the IP transfer. And the fourth is the confidentiality and inventions agreements, which are the ones that investors look at closely in due diligence. Let's start with the approval and share exchange. Both the foreign company and its shareholders have to formally sign off on the reorganization. The directors of the foreign company pass resolutions approving the reorg and the share exchange. Then every shareholder signs a share exchange agreement, which is where they formally trade their foreign company shares for the shares in the new Delaware corporation. That agreement lists the exact number of shares each person receives and serves as their evidence of ownership in the US entity going forward. From there, you set up the Delaware entity itself through 4 documents, starting with the Articles of Incorporation, Incorporator Consent, then the bylaws, then the initial board consent. The Articles of Incorporation set up the Delaware company and authorized 10 million shares for the exchange to happen. The Incorporator Consent hands the company from whoever filed the Articles of Incorporation to you as the sole director. The bylaws establish how the company operates. It covers shareholder and director rights, how decisions get made, and how the board is structured. And then the initial board consent is where you ratify all of that. You authorize the stock issuance to every incoming stockholder, elect the company officers, authorize things like opening a bank account and getting your EIN. Now, the IP assignment agreement is one of the most important documents in the whole stack. This is where the foreign company formally transfers all of its intellectual property to the Delaware Corporation, and you sign it twice. Once as the CEO of the foreign company to authorize the transfer, and once more as the CEO of the Delaware Corporation to accept it. Without this, the IP stays attached to the foreign entity, which means it's not under the control of the entity your investor is putting money into. Then there are confidential information and inventions assignment agreements, and there's one per stockholder. And these are the documents that investors look at the hardest in due diligence. Each person with equity signs one of these documents, and what it does is it commits them to keeping the company's confidential information private and automatically assigns any IP they develop in the course of their work to the company. Investors want to see that every single stakeholder has signed one of these documents because that's how they verify that all current and future IP belongs to the company they're investing in. If someone is missing one, investors will catch it in due diligence and it can hold up the close. Now the tax side. The Delaware flip has tax consequences beyond the legal restructuring. And this is something foreign founders typically don't expect. The share exchange, where your stockholders are trading foreign company shares for Delaware corporation shares, can trigger a taxable event depending on your home country's tax laws. Now, the tax rules in the US generally allow for what are called tax-free reorgs in instances where there is a share-for-share exchange, as in 100% of the shares of the foreign company are contributed in exchange for 100% of the shares of the US company, which results in the foreign company becoming a wholly owned subsidiary of the US company. The IP can also transfer without US taxation based on the share exchange because there isn't cash value being exchanged, but rather stock for stock. It just needs to be timed and structured correctly. However, foreign countries will have their own taxation rules around reorgs, and specifically the assignment of the IP to the US company from the foreign company. The reason for this is it's a way to ensure the foreign country keeps IP within the foreign country, or if the IP is leaving the foreign country, that the foreign country is paid for the IP that's leaving and going to the US company. This is sometimes referred to as an exit tax. The specific exposure varies based on where you're incorporated, but what I see repeatedly is founders who go into the flip without getting tax advice first and end up dealing with an unexpected liability after the fact. We recently had a founder who got into YC, but they didn't know about the tax issues surrounding flips. They set up their Delaware entity through Stripe Atlas, and they issued their shares not knowing that they were causing a problem. They tied their immigration visa to the entity they created via Stripe Atlas, and the moment they issued the shares to themselves, they created a tax issue because they could no longer do a share-for-share exchange. They already owned the shares in the Delaware entity, so they couldn't exchange them for the shares in the foreign company. They also couldn't shut the company down and restart it because that would lose their immigration visa that was tied to the existing company that they started. So they got themselves in a bind and their legal bill skyrocketed to fix the issues. The right move is to get tax counsel involved before you initiate your flip. not after. I also advise founders to talk to an advisor and a lawyer before starting an entity in the United States because, as pointed out above, there are timing considerations around the flip. You need to do a share exchange, and you can't exchange the shares if they've already been issued to you from the US company. So foreign founders should talk to a US lawyer before starting a US company. They also should speak with tax counsel from their home country about the tax implications of the flip in their home country. So if you're a foreign founder trying to raise from US investors and you need help getting the Delaware flip done right, including the documents, the IP transfer, the confidentiality agreements, and the tax planning before you start the process, book a free consultation call with me using the first link in the description. We'll go over your situation, figure out exactly what structure makes sense for your company, and map out exactly what you need to do. Again, you can book your free call with me by clicking the first link below this video. And if you want to learn how to answer the 12 most common questions investors ask in every pitch meeting, then watch this video next.